That surge of adrenaline you feel when a stock suddenly shoots higher is a powerful, intoxicating force. You see the price move, your heart races, and a voice inside screams, "This is it, the big one, don't miss it." You jump in, placing your trade right in the middle of that powerful green bar, feeling the thrill of participation. For a moment, you are right. The price ticks a little higher, and you feel the warmth of a correct decision. But then, just as quickly as it started, the momentum stalls. It hesitates. The price begins to retreat, pulling back from its peak. At first, you dismiss it as a small pullback, a chance for others to get in. But it doesn't stop. It erases your small gain, then it starts to eat into your initial capital. The strong green bar you bought into is now shrinking, leaving behind a long, accusing shadow above it. By the end of the hour, the price has collapsed back to where it started, or even lower. You are left holding a position at the absolute worst price of the day, trapped at the peak of that thin line. That line, that shadow, is called a wick, and it is not just a line on a screen. It is the footprint of a battle, and it tells a story you must learn to read if you are to navigate these markets successfully. The market is a continuous auction, a relentless battle between buyers and sellers. Every price chart is simply a visual history of this battle. To understand the wick, you must first understand the candle that it is attached to. Imagine a single candle on a chart, perhaps representing 1 hour of trading. The thick part of the candle, its body, tells you the simple outcome, where the price opened and where it closed. If the body is green, it means the price closed higher than it opened, a victory for the buyers in that session. If the body is red, the price closed lower than it opened, a victory for the sellers. This is simple, but it is incomplete. The body tells you who won the war for that hour, but the wicks tell you how the key battles were fought and where the turning points occurred. The wicks, also known as tails or shadows, are the thin lines extending from the top and bottom of the candle's body. They represent the highest and lowest prices reached during that period. They are the story of the extremes. Let's focus on that long upper wick that trapped our hopeful trader. A long wick at the top of a candle's body signifies a rejection of higher prices. It is a loud and clear message from the market. During that hour, the buyers were enthusiastic. They pushed the price up and up and up, creating that high point. This is the part of the story where the crowd gets excited, chasing the momentum. But at that high price, a significant force of sellers entered the market. These were not small, nervous sellers. This was heavy institutional supply. The volume of their selling was so great that it not only absorbed all the incoming buy orders, but completely overwhelmed them. They aggressively sold into the buying frenzy, forcing the price all the way back down. By the end of the hour, the price closed far below its peak, leaving behind that long upper wick as evidence. That wick is a monument to the seller's victory. It shows where demand failed and supply took absolute control. It is a sign of weakness, a warning that the upward momentum is facing powerful opposition. The higher the price went, the more selling it attracted like a magnet. Conversely, consider a long lower wick. This pattern tells the opposite story, a story of hidden strength. Imagine a market that has been falling for days. Fear is the dominant emotion. The news is bad. Everyone is selling. During one session, this panic selling intensifies and the price plunges, making a new terrifying low. This is the moment of maximum pessimism. Uninformed participants are selling at any price just to get out, to stop the financial discomfort. But at those low prices, a different group of participants begins to act. The large operators, the smart money, see value. They begin to absorb the panic selling. Their buy orders are large enough to meet all the sell orders without letting the price collapse further. They are quietly accumulating shares from the weak hands who are capitulating. Once the selling pressure is exhausted, the lack of supply allows the price to rally back up. By the end of the session, the price closes far above its lows, leaving a long lower wick. This wick is the footprint of demand. It shows precisely where the panic selling was stopped and where buyers took control. It is a sign of strength, a signal that the downtrend may be coming to an end because the selling has been met with powerful professional buying. The novice trader looks at a candle and sees only its color. The professional sees the story in its shape. The length of the wick is a direct measure of the intensity of the rejection. A small wick means there was little conflict at the extremes. A long wick signifies a major battle was fought and won. Think of it this way. A long upper wick is like a door being slammed shut in the face of the buyers. They tried to advance, but the door was slammed and they were pushed back. A long lower wick is like a floor being put in place under the price. The sellers tried to push it down, but they hit a solid foundation and bounced off. The chart is not just lines and colors. It is a psychological map of greed and fear, and the wicks are the most important landmarks on that map. They reveal the hidden intentions of the market's largest players. While the crowd is reacting to the movement within the candle's body, the professional is studying the message left behind by the wicks. This is where the true balance of power between supply and demand is revealed. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts allows you to see the wicks not as random price fluctuations, but as the deliberate actions of a composite operator, buying from the panicked and selling to the greedy. So, how do we transform this knowledge into a practical plan? How do we visualize and act on these signals? First, we must understand that context is everything. A single candle with a long wick viewed in isolation is meaningless. It's like hearing a single word without the rest of the sentence. The power of a wick comes from where it appears in the broader market structure. Let us visualize a long, sustained uptrend. For weeks, the stock has been making higher highs and higher lows. The mood is optimistic. Now imagine that after this long run-up, the price approaches a previous major peak from months ago, a level where a prior rally failed. At this critical resistance level, a candle forms with a very long upper wick. Its body might be small, showing indecision, but the wick is prominent. It tells you that as price tried to break into new territory, an army of sellers who were waiting at that old resistance level emerged and drove it back down. This is not a random event. This is a high probability signal that the uptrend is in jeopardy. The sellers have shown their hand. Now let's visualize the opposite. Picture a stock in a brutal downtrend. It has been falling for weeks, and the sentiment is one of complete despair. The price is now approaching a major low from a year ago, a level that previously acted as a strong foundation. At this historical support level, a candle forms with a long lower wick. The sellers tried to push the price into a final capitulation, but they were met with a wall of buying. Demand, which had been absent for weeks, suddenly appeared in force. That long lower wick is the evidence. It signals that at this specific price level, buyers believe the asset is undervalued and are willing to commit significant capital to defend it. This is a potential turning point. It's the first sign that the character of the market might be changing, from supply dominant to demand dominant. The wick is the first whisper of a potential new trend. Having this mental picture is the first step, but we need a clear algorithm for action, a plan that removes emotion and relies on objective rules. This plan consists of 3 parts: the setup, the trigger, and the protective stop. The setup is the context we just discussed. Is there a long upper wick at a key resistance level after a long uptrend? Or is there a long lower wick at a key support level after a long downtrend? This is the setup. You are not trading yet. You are observing. You are waiting for the market to prove that the Wicks message was true. This is where patience separates the professional from the amateur. The amateur acts on the wick candle itself, trying to guess the top or bottom. The professional waits for confirmation. The trigger is the event that confirms the Wicks story and prompts you to act. Let's take the bearish scenario, the long upper wick at resistance. The setup is in place. The trigger for a short sale or selling a long position is when the price on the next candle breaks below the low of the candle with the long wick. This action confirms that the sellers who appeared at the top are still in control. They have not only rejected higher prices but are now strong enough to push the price below the entire range of that battle. This is your signal to enter the trade. You are not guessing. You're acting on evidence. For the bullish scenario, the long lower wick at support, the logic is reversed. The setup is in place. You are watching and waiting. The trigger to buy is when the price on the next candle breaks above the high of the candle with the long wick. This confirms that the buyers who stepped in at the lows have absorbed all the supply and are now asserting control, pushing price above the high watermark of that session's battle. This confirmation tells you that the buyers have follow-through momentum. It's a much safer entry than simply buying blindly into the wick itself. You are letting the market show its hand first, and then you are aligning yourself with the force that has just proven its strength. The third and most crucial part of the algorithm is protecting your capital. Jesse Livermore famously said that the game of speculation is not about being right all the time, but about managing your losses when you are wrong. Your analysis will not always be correct. The market can do anything at any time. Therefore, every trade must have a predefined exit point for a loss. This is your stop loss. For the bearish trade entered after the trigger, the stop loss should be placed just above the high of the long upper wick. That high point represents the seller's line in the sand. If the price manages to rally back up and break above that level, your thesis is invalidated. The sellers have lost control, and you must exit the trade immediately with a small, manageable loss. For the bullish trade, the stop loss should be placed just below the low of the long lower wick. That low is the foundation built by the buyers. If the sellers regain control and manage to break that floor, your reason for entering the trade is no longer valid. You must accept the loss and move on. Placing the stop loss based on the market structure, the high or low of the wick, is a professional approach. Amateurs often place stops based on an arbitrary dollar amount they are willing to lose, which has no connection to the market's behavior. Your stop loss must be logical. It must be the price level that definitively proves your trade idea was wrong. By defining this point in advance, you remove the element of hope. You will not sit there as a small loss turns into a significant drawdown, hoping the market will turn back in your favor. You have a plan, and you execute it with discipline. But what happens if the market does not provide a clear trigger? What if, after the candle with the long wick, the price simply moves sideways? This is also valuable information. If after a long upper wick the next few candles do not break the low but instead trade in a narrow range, it signals a state of equilibrium. The sellers were strong at the top, but the buyers have not given up completely. This is a moment of indecision. The correct action here is to do nothing. You wait. You continue to observe until the market breaks out of this small consolidation, either up or down. A sideways market after a rejection wick is a sign of a more complex battle, and it is wise to stand aside until a clear winner emerges. Patience is not just a virtue in the market, it is a profitable strategy. Another critical variable is volume. Volume measures the amount of activity, the number of shares traded. It is the effort behind a price move. A wick tells you the story of rejection, but volume tells you how significant that story is. Let's return to our long upper wick at resistance. If that wick formed on a massive surge in volume, it is a highly credible signal. The huge volume confirms that a major battle took place. It was a clash of titans, the enthusiastic public buying versus the large institutional sellers. The high volume shows the intensity of that transfer of ownership. This is a 5-star warning sign for the bulls. However, what if that long upper wick formed on very low volume? This is a much more ambiguous signal. It could mean that the upward move simply ran out of buyers, and it only took a small amount of selling to push it back down. This is not a sign of aggressive heavy supply. It is a sign of apathy. It's a potential warning, but it carries far less weight than a high-volume rejection. The same logic applies to a long lower wick at support. If it occurs on a massive spike in volume, a selling climax, it is a powerful sign that the panic selling has been absorbed by strong hands. If it occurs on low volume, it is less reliable. It might just be a temporary pause in selling, not a definitive reversal. Always look for volume to confirm the price action. Effort must validate the result. A long wick on high volume is a shout. A long wick on low volume is a whisper. You must learn to listen for the difference. Wicks are also instrumental in defining the boundaries of a trading range. Markets do not trend forever. Often they enter periods of sideways consolidation, building cause for their next major move. During these periods, you will often see a series of long upper wicks at the top of the range and a series of long lower wicks at the bottom. These wicks are painting the borders of the battlefield. The upper wicks repeatedly show you the price level where sellers become active and supply comes into the market. The lower wicks show you the price level where buyers step in and demand absorbs the selling. By observing these wicks, you can clearly define the support and resistance levels of the range. This is incredibly valuable. It prevents you from buying at the top of the range, right where sellers have repeatedly shown up, and it stops you from selling in a panic at the bottom of the range, right where buyers have consistently provided support. The wicks are the guideposts that keep you safe within these periods of consolidation. In conclusion, a candle's wick is far more than a simple line on a chart. It is a detailed narrative of the struggle between buyers and sellers within a specific time frame. It reveals moments of rejection, capitulation, and absorption that are invisible to the untrained eye. A long upper wick is the shadow of supply, a warning of potential weakness, especially when it appears at resistance after a long advance and on high volume. A long lower wick is the footprint of demand, a signal of potential strength, particularly when it forms at support after a lengthy decline and is confirmed by a spike in volume. But this knowledge is useless without a disciplined plan. You must learn to identify the proper setup, wait for a clear trigger for confirmation, and always protect your capital with a logical stop-loss. The market speaks a language of price and volume. Today you have learned to read one of its most important words, the story told by the Wicks. If you wish to become fluent in this language, to understand the deeper grammar of market phases and institutional behavior, then continue to study. The market rewards the prepared mind. If you want to understand more, stay with us.